Is value investing dead? Now, just to let you know that for those people who have done some videos talking about value investing is dead, or some people who have written articles that saying that value investing is dead, right? Actually, what they did was they cherry pick certain things and then they amplify it, and then they use that information to say that, hey, value investing is dead. Yeah. So maybe let's go into a very broad stroke, right? Instead of just cherry picking on certain things and then amplifying, right? And then after that, you twist into something that you want to say. Yeah. So let's come to this part, right? First, we must understand, right, how value investing has evolved. Yeah. Now, in order for us to answer whether value investing is dead, right, we have to understand what value investing truly is and how value investing has evolved. Now, all of you is our graduate. You already taken our 4 days value investing program, right? Everybody would know who is this person, and his name is called Professor Benjamin Graham. Now, he's the founder of value investing. He created value investing in the first place. And we must understand that whether it's Benjamin Graham or Warren Buffett, right, in the early days, they have lost money before. And because they have lost money before, they are worried about losing money, right? It's like when you've seen ghosts before, you're afraid of the dark. When you've drowned before, you're afraid of water. If you're bitten by, let's say, a dog, you're afraid of the dog. So it's the same thing. And because most people lost money, Professor Benjamin Graham want to create an investing methodology, right, that could protect the downside. Yeah, so that the chances of us losing money is very low. And if we're able to protect the downside, then the upside, which is clocking money, right, will take care of itself. Yeah, so we must understand his priority is to protect our income. And of course, because of that, he started value investing and he founded value investing in 1920s. And until today, right, just to let you know that the history of value investing has been around for the past 100 years. And of all methodology, whatever methodology that you have ever think of, right, there is not one single investing methodology that has been proven across 100 years. But of course, if you are able to find one, please comment on this video, right? And because of that, he has been working. He started teaching at Columbia University while managing his own investment fund. But of course, we must appreciate that Benjamin Graham, because he has lost money before previously, right? He want to come up with a strategy, right, that could take care of the downside. So his strategy is predominantly to buy cheap companies. Technically, right, it's called net company. So what do you mean by net company? Now, during our 4 days value investing program, we have covered this 3 financial statement, right? And one of the financial statement is called balance sheets. Yeah, balance sheets. Yeah, so balance sheet simply is a financial statement that records down what are the things that the company owns and what are the things the company owes. So what are the things that the company owns is called asset or assets. Yeah. The things that the company owes are called liabilities.
Hi, this is Cayden. Remember to click on the subscribe button and turn on the notification to be notified of our future training videos.
So assets, there are 2 types. Predominantly, one is called current assets and the other one is called non-current assets. So what are current assets, right? Current assets are simply assets that could be liquidated, that could be sold in 12 months or less and turn into cash. So these are current assets. Now, on the other hand, right, those non-current assets, which are sometimes known as long-term assets, are simply assets, right, that takes more than 12 months for the company to convert to cash. Yeah. So current assets, non-current assets. So for liabilities, the same thing. Yeah, there are 2 types of liabilities. One is called current liabilities, and the other one is called non-current. In other words, long-term. It takes long time for you to pay off. So for example, if you are staying in a HDB flat, the loan, right, that you take is a long-term liability. So when you see net company, what does Benjamin Graham means, right? It simply means that he take the current assets only, excluding non-current. Okay, current assets only, excluding non-current, and then he minus all the liabilities, which is current and non-current, right? Yeah. So you end up with something. Right? So that is called that's called the net current asset value. Okay. Yeah. Then he take this net current asset value, right, divided by the total number of outstanding shares. So we end up with this net current asset value per share, right? Per share. Yeah. So if I can draw one graph right over here, it looks something like this. NCAV per share. Yeah. And if you draw one line over here, NCAV per share, let's say it's $10. Yeah. So what's the net company? The net company is the current shares is below this NCAV per share. Okay, it's below this NCAV per share, right? So for example, the share price may be $9. Wow. So if the share price is $9, right, in this case, which is lower than the net current asset value per share, right, then this company is a net company. Yeah, so Benjamin Graham don't really look at the discounted cash flow, looking at the future earnings ability. No, he just look at your company. Tell me what you have today. I'm not really interested about what you can do in the future. Just tell me what you can do today. What you can do today, right? Okay, so this is a net company. So remember, that's how value investing got started out. Now, then what happened is, of course, Warren Buffett during his younger days, he went to attend, right, this Benjamin Graham's class. Yeah. And after he attended Professor Benjamin Graham's class, of course, he learned the net. So because he learned from his teacher, right, and the teacher say, hey, value investing, this is how it works, net current asset value per share. So of course, being a disciple, being a student, he applied what he has learned from his teacher. So eventually, right, he used the method to buy over a textile mill located in Massachusetts, right, called Berkshire Hathaway. So after I think it took about 3 years, eventually acquired the entire company. And after he acquired the entire company, right, he realized that this company, even though it's cheap, yeah, it wasn't that fantastic. It wasn't that fantastic is because the ability that Berkshire Hathaway, being a textile mill, to generate income, right, is getting lesser and lesser. So it still makes money, but the amount of money that it's making is lesser and lesser. So that really makes Warren Buffett worried. Yeah. What if one day the Berkshire Hathaway couldn't continue to make money anymore because it's getting lesser and lesser, right? So he knew that finding a net company is good, but perhaps not good enough. So during this whole journey, right, of investing, right, he was figuring, is there a way out, right, better than this, huh? So he bumped across two people, right, which adds on what he has learned from Professor Benjamin Graham. And the first person is called Philip Fisher. Now, Philip Fisher is famously known for writing a book called The Common Stocks, Uncommon Profit. Just give me a second, right, while I pull out this book so that I can show you. Yeah, so this is how the book looked like. It's called Common Stocks and Uncommon Profit, written by Philip A. Fisher. Yeah, so this Philip A. Fisher, together with Charlie Munger, right? Charlie Munger, I think he has wrote one book. Give me a second. This is a really huge book. I think it's quite, right now you have money, maybe you will find it very difficult to buy. Now, this book is called The Wits and Wisdom of Charlie Munger. Yeah, Poor Charlie's Almanac, but it's not really poor. Yeah, so these are the two books that he has written. So of course, after Warren Buffett got to know Charlie Munger better and Philip Fisher better, right? He realized that, hey, looking for a cheap company is good, but it will be better if you can find something that is good and yet cheap. So remember, value investing started off with the word cheap. Yeah, but as of today, right, it has evolved with another extra word in front, and it is good. So we want something that's good and we want something that's cheap, so that the chances of the company closing down is very little. And not only that, the future earning ability of the company is greatly improved. So Warren Buffett's philosophy, right, of value investing has evolved after he has bumped into Philip A. Fisher and Charlie Munger. So as of today, right, now I'm going to play a short video, but I'm going to increase the volume, right? Okay, ready? Now in the next video, as I've shared during a 4 days value investing program, there's one lady did ask Warren Buffett what makes a good business. And from the way he explained, you will appreciate that, value investing did evolve with times. So here it goes.
What by Buffett standards is a good business, and then go into why does the car dealership business look like a good business to you?
A good business is the one that earns a high rate of return on tangible assets.
Very simple.
That's pretty simple, yeah. And the very best businesses are the ones that earn a high rate of return on tangible assets and grow. But even ones that don't grow, if they earn a high return on tangible assets, and then of course if you don't pay too much, they can be a good investment. They're a good business to start with by the high returns. If you pay too much for them, you can turn a good business into a bad investment. But if you pay an appropriate price, you can do all right. Now the big mistake which we made in the early years was to try and buy a bad business at a really cheap price, and it took me about 20 or 30 years to figure out that wasn't a good idea.
So in that short video, Warren Buffett has summarized that there are 3 types of business. And out of the 3 types of businesses, right, there are only 2 types that he liked. So in his very own words, he said the best kind of business are those with a high rate of return on tangible assets and grow. Now, the second type of business, in case you cannot find the best business, right, are good businesses. In other words, the company still has a high rate of return on tangible assets, but if you don't pay too much, that means you pay at a undervalued price, right? You can still make good money. Now, if you do not pay at a relevant price, you might turn a good business into a bad investment decision. So these are the 2 kinds of businesses that Warren Buffett likes to buy today. And you realize that if you compare these 2 investment endpoint, right, and his original value investing, right, which is to find net companies just purely on balance sheet, it's totally different. And of course, the last kind, right, he say, oh, it took me like 30 or 40 years to find out, is to avoid investing in a bad business. And even if the business is at a cheap price or is free, right, he will avoid it at all costs. So in short, right, value investing today, based on Warren Buffett's perspective, consists of 2 types of business. The best type are the high rate of return on tangible assets. The other one is still high rate of return on tangible assets, doesn't grow, but if you pay at an undervalued price, it's still okay. So in short, if I may summarize it, right, what we want to buy, or what is value investing today, right, is to find a good business that grows so that your capital gain goes up, and then you buy it at a really cheap price. Now, the second one is if you cannot find the first type, you go for the second type. So in other words, you find a good company, it doesn't grow, but it's still cheap. So either one of this, there's a high probability you can still make good money, and yet your downside is being protected. Of course, is to avoid the bad company at all costs. Now, then, even though through the eyes of Warren Buffett, value investing has evolved, and he has used like the modern type of value investing versus the net type, right? Just to let you know that in Singapore or other parts of the world, there are still people who likes the Benjamin Graham type of investment philosophy, which is the net company, the cheap company, or sometimes people call it the cigar butt company. Yeah, so Benjamin Graham. And Benjamin Graham has another disciple other than Warren Buffett, right? It's called Walter Schloss. Now, Walter Schloss and Warren Buffett, they are classmates. It's just that, as the years go by, Warren Buffett has adopted a new approach, and Walter Schloss continued to use the net approach. Yeah. So even until the very last day when Walter Schloss passed away, the ROI that he has generated using the net, right, is more than 20% per year. Yeah, per year. So Walter Schloss, even though he didn't use so-called the modern way of value investing, he still make good money for himself and his investors. And of course, the current modern way of value investing, right, is Warren Buffett. Yeah. And before Warren Buffett, I also mentioned about this Peter Lynch during our 4 days value investing program. So you can see whether you are a net kind of person buying companies, like cheap companies, just purely on a balance sheet, you are still a value investor. So if you're looking for some fast growth company, whether it's Amazon, Apple, and so on, you are still a value investor. Yeah. So it's just how people use the name. But of course, sometimes people, they do not use the word value investing or value investor. They say they are a growth investor. Yeah. I'm not very sure specifically what is the definition of growth investor, but if you are able to find a good company and it's growing, right, do you consider yourself as a growth investor? So that's one question. Then another one is sometimes people like to use another term called income investor. So income investors are predominantly investors that they buy big companies like blue chip stocks like DBS, OCBC or whatever, and then they just want to collect dividend. So regular income, that's good enough. Yeah, maybe it grows slowly, maybe it doesn't grow. Yeah, so in the world of education, there are a lot of terms. Whether is it a growth investor, whether is it income investor, whether is it value investor. So whatever terms that's being attached to it, we must understand that ultimately we want to buy a business that doesn't close, because when it closes, we lose money with it. Yeah, lose money. So obviously you want to find a good business. And when you find a good business, you also want the share price to grow, right? As fast as the company. So remember, only when a company grows, then the share price will grow. So it will be nice if you can find a good growing company. Yeah. So I already described to all of you the two ends of the value investing, starting from net, right, until the modern way of value investing, which is involved finding a good company and growing company. So going back to the question, is value investing still relevant? To me, it's yes. To me, it's yes. Now, I'm not sure about you, but it's okay, right? It's okay. Now, if you find that it's not relevant, you have found another alternative way of investing, so good for you. But to me, I think for my personality, right, where I no longer wanted to lose money, I want to sleep nicely, I want to buy a company, that could stay with me for the rest of life, right, without me worrying. It's like marrying my wife, right? I think value investing suits me best. Okay, so that is to answer the question of whether is value investing dead, which brings me to a very interesting article, right? And the title is called The Super Investors of Graham and Dodd's View. Now, just to let you know that this article is written by Warren Buffett in 1984. And in this article, he listed down a lot of super investors. Yeah. Walter Schloss, remember? Yeah, his company is called WJS Partnership. Tom Knapp, not very popular. Bill Ruan, yeah, also not very popular. Charles Munger, you already know. Now, I want to talk about this guy called Rick Guerin. I'm not very sure did I pronounce his name right. Let's call him Rick. Now, Rick has started a company called Pacific Partners, and we need to appreciate that Warren Buffett, right, named this Rick a super investor. I mean, if Warren Buffett named you as a super investor, it must be something, right? And he wrote an article, and then it was released by the Columbia University. So it's well circulated in the world of value investing. So everybody knows that, hey, this guy Rick is not a simple fella. But what's so big deal, right, about this Rick? Is he really better than Warren Buffett and Charlie Munger? Now, this table is being extracted from the article, just now, the Super Investors of Graham and Dodd's View, right? Now, there's one diagram I just want to share with you, right? This table shows the ROI of this Rick's company called Pacific Partners, and he compared with the S&P 500. Yeah. So S&P 500 19-year compounded gain. That means cumulative, right? Is from this 1965 to this 1983, right? Is 316%. But if you look at Rick's company, overall partnership, right, is 22,000%. 22%. This becomes this, which is why Warren Buffett says he's a super investor. Now, then if you look at his yearly, right, annual compounding rate, S&P 500 is about 7.8%. Now, if you look at this Rick's a partnership company, is 32.9%. Now, just to bear in mind that for Warren Buffett's Berkshire Hathaway, right, since 1965 until today, their annualized compounded annualized growth rate is about 20%. Yeah, so Rick's track record is far superior than Buffett. It's 32.9% versus 22%. Yeah, so Warren Buffett and Charlie Munger know this Rick is no ordinary fella. And because of that, right, they wanted this Rick to be their partner. So right now, it's only Warren Buffett and Charlie Munger, right? So I want you to imagine Warren Buffett, Charlie Munger, both of them hunt for Rick and want Rick to be part of them. Now, so eventually, did Rick join Warren Buffett and Charlie Munger? This is a very interesting story. But before that, I want to talk about this book. This book talks about the psychology of money, written by this guy called Morgan Housey. Yeah, Morgan Housey. So what happened was this Morgan Housey went to interview this Monish Prabhai. And this Monish Prabhai is a very famous value investor. He's being famous for copying Warren Buffett shamelessly. Yeah, so it's fun. He's also doing very well because he copied Warren Buffett shamelessly. And this Morgan wanted to interview Monish because Monish paid for the expensive lunch. Remember, anyone who want to have lunch with Warren Buffett, you have to pay more than 1 million, right? So Monish Prabhai is one of them who has paid the millions of dollars of lunch in order to have Warren Buffett. But of course, when you have lunch with Warren Buffett, you want to ask important question, right? So over lunch, this Monish, right, did ask Warren Buffett about Rick. Yeah, and Warren Buffett replied, Monish, what happened to Rick? And Monish, right, took the answers and then replied to Morgan when Morgan interviewed him. So that's how it goes. Now, so I want you to look at this portion, which is very interesting. Yeah, interesting, right? Now, this is a transcript. This is a transcript where Monish Prabhai, right, a reply this Morgan during the interview. Yeah, so he said something like this. Yeah, he said, ask Warren Buffett a question about Rick. When Charlie Munger and Warren Buffett started out, there were three of them. It was Charlie, Warren, and Rick. Yeah, they were one gang, right? One gang. Then after that, what happened was they used to make investment together. Yeah, even though they ran separate funds, right? Now, in fact, even when they did seize the Seas deal. Now, this Seas deal is Seas Candy. Okay, Seas Candy. So this Charlie and Warren, right, had interviewed Chuck to be the CEO together. So I want you to imagine that these three fellas, right, went to interview the Seas Candy CEO. Yeah, they want to invest in Seas Candy. Yeah. Then Rick, right, pretty much disappeared. Suddenly one day he just vanished. Yeah, in the life of Warren Buffett and Charlie Munger. So now the question is, what happened to Rick when he's a super investor? And in fact, his performance is better than Warren Buffett, right? So Charlie and I always knew that Rick would become incredibly wealthy. And as he said, we are not in a hurry to get wealthy. We knew it would happen. Yeah, but Rick was different. Yeah, Rick wanted fast. He wanted to get rich quick. Yeah, he was in a hurry. So what happened then? It was in 1973 and 1974, right? Rick was leveraged. So he used margin account. Yeah, with margin loans. And what happened is the stock market went down almost 70% in those 2 years. Yeah, so there was a black swan event. He didn't expect it. Then he kena this margin call, right? Yeah, kind of margin call. So no choice, right? Whatever holding he has, he's being forced to sell away. So eventually he has to sell his stock to Warren Buffett. And during that time, it's only $40 per piece. So you can imagine right now, I think the stock is about 200 over 1,000, right, per piece, right? Yeah. So Warren Buffett went a step further. He said that what he's trying to say is that if all of us know more about value investing, we are already above the average person walking on the streets, right? And we spend less than what we earn. So we continue to do this over a lifetime, right? You cannot help but to get rich as long as you are patient. Of course, what he's referring to is Rick. So the lesson that he has told Monish Prabhai, right, is the lesson is, as long as you're smart, do not borrow, do not use leverage. So if you look at this diagram, you can see there are some people, right? In fact, there are many people whose return, right, is far superior than Warren Buffett. Yeah. So let me share where is okay, this is Walter Schloss, right? Now, how do you read this diagram? This part over here, this percentage over here, right, is the annual excess return over S&P 500. Yeah. So in other words, if this 5%, right, it simply means that S&P 500 is 10%, but it's 5% excess of this 10. Yeah, excess of this 10. So all these investors are those people who have beaten S&P 500 by 5%, 10%, and so on. So the highest one that you can see here is Jim Rogers. Jim Rogers right now is residing in Singapore. Everybody knows. Yeah, but the question is, if Jim Rogers' return is super high, right? How come he's not in the top 10 Forbes list? Yeah, for a simple reason is if you look at Walter Schloss, if you look at Sir John Templeton, if you look at Warren Buffett, their ROI may not be as high as Jim Rogers, right? But they invest for a very long term. Remember, the key word is patient. You know, I didn't do as good as Jim Rogers, but it's okay. 10%, 15%, 20%. I keep on doing. The longer I do, right, one day my accumulated wealth will be richer than those who are doing sprint. Okay, which bring us to one point. Yeah. So I'm going to close out this lesson before I hand over to Ali, right? Yeah. So what's the lesson? Now, in this book written by Morgan Housel, which is Psychology of Money, right, there was this guy called Nassim Taleb. Now, Nassim Taleb is a former option trader. He's a risk analyst. He's some smart mathematical statistician who eventually tried to come up with certain theory, right? Yeah, how to make money from the stock market. So eventually he came up with one simple advice to all of us. He said having an edge, yeah, and surviving, right, are two different things. Yeah. The first requires the second. Yeah. You need to avoid ruin at all costs. Yeah. So what is he trying to say? You need to avoid ruin at all costs. Don't it remind of our investment rule number 1, which never lose money? So I'm going to close my session, right, with some key learnings, and also to add on to the question whether is value investing still relevant today. Now, so to do well investing, these are some important lessons as far as my perspective is concerned. So number one, if we are able to generate consistent return, right, over a long period, which I've shown you the graph previously, right? Now, it's definitely far better that if you can generate like a one time of high ROI, but over a short term. Then after that, that's it. So consistency over a long term will make all of us richer than those people who get rich quick if they're rich. The second thing is getting rich takes time. Remember, Rick wanted very fast. Rick wanted fast, end up with leverage, right? Because that's how fast you can do. So Warren Buffett has an interesting quote. No matter how great your talent or your effort, some things just take time. Now, you can't produce a baby in 1 month by getting 9 women pregnant. A bit of sarcasm over there. Brings us to point number 3, right? Which is investment rule number 1, never lose money. Now, we can make money. We can make money. Short term, we can make a lot of money, whatever, buy options or whatever, right? Or you're very good in saving money. But the key thing is we must be able to be consistent over many years. And sometimes we may make money very quickly, over 1-2 years, and we try to boast about it. But remember, you only take one instant, one act of speculation, right, to lose whatever money that we have previously saved or speculated. So these are the 3 learning lessons. Now, which brings us to another photo, right? This photo popped out in my Facebook memory. And this photo was taken on the 23rd November 2001, which was 9 years ago. And previously, I do not have a training venue yet. So I rented a room in Bras Basah. Bras Basah. So you can see all these people. Some people are, I still remember this lady. Her name is called Haji Kao. This one of my ex-colleague. This uncle I still remember. Dave, a very good friend of mine, one of our NLP graduate. The rest of them, I think their faces still look familiar. I'm not sure what happened to them. The reason why I want to share this is because during that time, right, if they do something consistently, but bearing in mind that sometimes we pick the wrong stock, sometimes we lose money. But the key thing is overall portfolio must perform. And let me just show you one graph. Remember the photo was taken here, right? Was taken here, which is on the end November 2011. And during that time, the VOO, which is a S&P 500 ETF, is only 106. 106. Now, so I want you to imagine that if they did bought VOO consistently, dollar cost averaging, value averaging, whatever. Over this period of 9 years, this is the share price today, right? The compounded annual growth rate will be 13.28%, which means that they were beaten most professionally managed funds.